Welcome everyone. Thank you so much for joining this webinar. Today we are going to talk about an interesting topic, AI meets credit bureau in lending. So I'll start with a small story, right? So that you can easily resonate with what we are going to talk today. So let's take an example story where a teacher comes to us and says that student A scores 90 marks and student B scores 70 marks. So now if the teacher asks who's performing well, so what is the answer? You can type in the chat option. So student A scores 90 marks, student B scores 75 marks. Who's performing well, right? Out of 100, Barney. Yeah. So who's performing well? So this is a straightforward answer, right? I think everybody knows that. Correct, student A only. But now if you ask an AI and then it goes and sees the historic data and identify that student A has dropped from 98 to 90 and student B has increased from 35 to 75, right? So now the entire story changes. Who's performing well? So is it the student A or student B? So this is what the AI is going to do us. So that is the main context for this meeting. So you've been analyzing, you've been talking about the same bureau data we usually see it in the credit bureau, but what different sort of patterns, different sort of data that you can analyze while seeing the credit bureau report. This is what we are going to do it today. Okay. Uh, Before that, I just quickly share my screen and then explain what our company does. I won't even take 2 minutes of my time. Okay. So yeah, here you go. Are you able to see my screen? I hope you are. So Cloud Banking, this is our company and we have been doing digital lending from 2019. And we have almost 50 plus customers who are using our solutions. And we are ranked number 1 in G2.com in digital lending category. And $15 billion assets has been managed through our platform. And these are all our investors, and these are all the countries that we are serving. And we have got incubated by Bank of America in 2023 lab. And these are all the solutions that we are into, starting from origination till managing the entire portfolio. We are able to serve the lending institutions, including banks and NBFCs. So we'll just quickly get into the topic. I would like to introduce Mr. Hari Kumar. He's our senior business analyst. He's a banker. Important point what I want to highlight is I don't want to discuss anything on the technology side because this webinar is going to be completely on the business case of it, right? If we talk about algorithms, logistics regression algorithms or statistical algorithm, then this session may not be useful for everybody, right? We want to explain that in a very layman terms, that also from the banker's perspective. That is why I intentionally have Mr. Hari Kumar, who's as senior business analyst in our company, who's an ex-banker, who's also going to share the screen and then explain the context here. Hari, over to you, Hari.
Hi, everyone. Can you hear me? I hope you can hear me, right? Okay, so great. Thank you, Mani. Thanks for the short introduction. So just to give a small brief, probably a couple of minutes, I have close to about 17, 18 years of experience in the banking industry. Majority of it was into lending. So I was working in various departments like sales, credit, collections, front end role, basically, as far as the NBFC is concerned. From there, I've moved on here. With that experience, I've just joined cloud banking, and we've been doing a lot of analysis and changes in the entire structure per se, as far as making things better for the clients of whom we have. So let's just quickly get into the topic, what we are here for. Can you see my screen? Right.
Yeah, Hari.
Okay. So So when we think about credit bureau, right? So credit bureau, of course, obviously is there are a lot of things which comes into play when we try to analyze the behavior of a customer, right? One of the major piece is a credit bureau information. So we are here to talk only about that particular piece for this webinar, what we are having, and how using artificial intelligence we will be able to predict a few things which you will not be able to see when you look at a report by a glance or by a human eye, right? So this is the session is about. So just want everybody to uh, see this. 15 years ago, right? So we were when probably our fathers or our grandfather or even us for that matter, 15 years ago, when we drive a car, what we do is we'll have to manually look at a map or we need to ask people on how to go to a place, right? You need to manage the steering, you'll have to operate the clutch, the gear, the brake, accelerator, everything. You'll also have to imagine you're traveling down a beautiful scenic road. You will not be able to enjoy the view, what is there. And also there would be people sitting next to you. You may not be able to have a good conversation with them because you will have to completely focus on the road. So this is the scenario what we had probably about 15 years ago versus today. AI has come in where uh, you know great manufacturers like a Tesla, all you have to do is just probably enter the destination, keep your hands on the wheel. AI does all the decisioning for you with so much amount of precision that even a human may not be able to do, right? It calculates thousands of variables in a matter of a few seconds on what is going to happen and how it needs to react. So your work is reduced to a great extent, right? So this is as far as a small analogy when it comes to driving. And the similar thing is what we are going to have with respect to credit underwriting. There are a lot of organizations who have already started to adopt this, right? And this is going to be the future. And so moving on, uh, like I said, organizations are at a different level as far as bureau decisioning is concerned. As far as the adoption of bureau decisioning is concerned, few of them are on the manual phase where a bureau is pulled. Credit manager checks every single field by hand, making a note of which are the months that the customer has defaulted and how much is the overdue amount. He marks a note of the loans that is there. He marks a note of the EMI amount, the outstanding amount. He enters the amount in an Excel sheet, try to bring about a CAM or an eligibility sheet, and then tries to build an entire proposal together. So this is one part. Second one is a semi-manual where there is a decision engine like a BRE which is already in place. So once the data comes in, the BRE tries to segment customers saying that this is a reject or this is a approve or this is something that needs to be reviewed. And then it passes and the credit manager still sees the file and he will have to still put in his effort in terms of trying to understand the entire proposal, makes a CAM again, and then he sends it as a recommendation. The third phase, I could probably say, is called as a semi-automated stage. This is where the bureau is parsed and the risk category is being defined by the engine which is already in place. Credit manager will come into play and then he still looks at each file and then decides. The difference between a semi-manual and a semi-automated is where the proposal is being brought down by the system, right? Manual is where you read the data manually and then you fill in the CAM. Semi-automated is where the entire data is parsed by the system. The credit manager will have to take a decision on every single file. He will still have to go through the file and then he decides. And then the last phase of bureau decisioning is the behavior intelligence, where system reads every single parameter. It derives at a score, arrives at something called as a probability of default, and then makes a decision. This is based on the inputs that is given. This is based on the learning what the AI had made, also as well as the existing customer database on how you would like your system to behave. So this is already created. Credit manager or the credit team is being referred only for edge scenarios. So let's say almost close to about 75 to 80% of the decisioning is done by the decision engine, and the remaining is where the human intervention is taken care of. So this is all the four levels of bureau decisioning. There's going to be a small poll that we would be conducting. So you can just give your honest answer in terms of where are you in these four phases is concerned as far as your organization or you are concerned. So we'll just take next 15-20 seconds time for us to just fill in the details.
So there is an option in the chat that the live poll. So whether it is manual, semi-manual.
Okay, so we've got about some 7 or 8 votes so far. I can see almost close to about 69 people here. So leaving apart, at least if we can get about 50 responses, it would really be a great number. So we can take about another 15-20 seconds. I request if someone has not filled in, so please click on the chat box. You'll be able to see a poll. You can please mention your answer, or you can select your vote. Okay, so we've got about 20 votes, 23, and still coming. Let's wait another 10 more seconds. Let's make this a more interactive session. So inputs from you is something that's going to make this more better.
I think we have to say like this, we will not move again. We will not move further if the vote has not been done.
Yeah.
Guys, please cooperate.
Another 5 more, at least let's get till 30. Okay, so from whatever poll that we have had so far, we're able to see that most of them are there in the second and third phase. Second being the highest, which has got close to about 50%, and third is being semi-automated is being the next, and then still we are able to see people who are on the manual mode. AI and intelligent driven automation is about some 10%. So this is where we are, and how as uh, organizations, how we will be able to move on to the next level, which is level number 4. People who are in semi-manual will have to adopt into the next kind of a thing. So that is what we will be seeing in this session, right? So when we look at a credit bureau, right, in a today's environment where a credit manager kind of opens a report, what do you think he sees? The first thing what a credit manager would see is a credit score, right? Then what he would look at is the payment history on how the customer has repaid his earlier or existing loans. Then he would take a look at what are the active trade lines for them to calculate the eligibility or how much of leverage that the customer already has. Then we look at the EMI obligations where you will have to arrive at a fixed FOIR so that you will be able to give the eligible loan amount, right? Then we look at overdue or DPD, which is there. And then you also look at enquiry details of a customer. So these are the basic few things which a credit manager checks today when he looks at it. So this particular slide or the inputs is received from industry. We've spoken to over 20-30 credit managers, and we try to understand what is that they look at when they look at a credit bureau, right? And this are the details which are looked at even for deciding a high ticket volume. So high ticket could be different organization to organization. So affordable housing finance would say 20-25 lakhs as a big ticket, whereas a prime lending would say 3 crore as a big ticket. So when I say big ticket, it is organization wise. Even for a big ticket, these are the basic ones that are being looked at when it comes to credit bureau. Okay, so what if I tell you that the bureau holds about 1,000 plus parameters? I just listed out 6, right? And when we look at the overall picture, people look at probably about, let's say 20 or 25 or 30 parameters in a credit bureau, right? So that is the average that they usually take in order to make a decision. So think about it like this. You're going to a star hotel, let's say 5,000 rupees is a buffet. You pay the money, you get inside, your seat is allotted, and then you get a plate. You pick up the plate, go serve yourself a little bit of curd rice, come back, finish the curd rice, and then you leave. So this is the analogy that I would like to give as far as today's credit bureau analysis is concerned. So when thousands of information is available, when you can have a full-fledged meal for the money that you've paid in a star hotel, you end up having just curd rice. So this is what is happening right now. So out of our overall analysis which we have done, on an average, only about 3% of parameters or predictors are being used, whereas 97% of the predictors or parameters are not being used while arriving at a decision when it comes to uh, a credit bureau. So there's going to be another poll where I would request everyone to participate. Honestly, when you look at a credit bureau, how many parameters do you see? Like what I mentioned in the earlier slide, credit score, DPD, enquiry details. So how many parameters do you see or you analyze before arriving at a decision? The poll is already there in the chat section. Please open the chat. It would be visible, so you can start voting, please. Okay, I request everyone to select in the poll. We have received about some 20 responses. Last time we had about 33 responses. Let's see if we can beat that. If we can get to 40, it would really be great.
I think there are somebody who was not able to respond. If you are not able to do the poll, you can press the. I mean, you can enter the text answer so that we can take it up to the next level. Kindly fill it in the chat. If you are not able to vote, please put it in the chat option whether what option that you wanted to opt.
Okay, we'll wait for another 10, 15 more seconds. So we have 78 people now, which is higher than what we had last time. So I'm sure we can beat it. So 26 is received so far, another 10 more or 15 more. Let's see if we can get to 40. Please open the chat and you can see the poll. You have to click on submit vote and then you can select. Okay, so from the votes as well as the feedback that we have received from the people in the industry, so 10 to 25 is something which has got the highest amount of votes. And this is something that we have got from the industry as well, where people say that they check less than 30 parameters when it comes to bureau decisioning. So this is something that really needs to be looked at because uh, this is where the future is going to be. You are just missing out on a large chunk of data which is already available in the bureau. So I request Money to take over from
Yeah,
for him to explain a few things about how AI is going to help us analyze these things. Yes, over to Money.
yeah, sure. Thanks, Hari. Thanks a lot. So now let's get into the basics, right? What does the AI engine does? Basically, it identifies the good versus high risk customers, right? So let's talk about this. What is there in the left hand side and what is there in the right hand side, right? The left hand side you have a lot of parameters like 1,000 variables. What Hari was saying, that includes some basic variables. I've just put that basic variable just for your thinking purpose, but there assume that there are a lot more variables which Hari is going to explain in a later stage. The point is, uh, the left hand side you have the list of variables. In the right hand side we have who's good, who's performing well, like I said before, right? Who's performing well and who is not performing well, right? We have that particular classification. In the right hand side you have the answer, right? Who's performing good. So now the system will identify, okay, these customers are good customers. Then what are the characters that are associated for that particular good customer, right? So AI analyzes that and then identified, okay, so if Money is a good customer, then what are all the characteristics of Money? What do you mean by characteristics, right? So what is his age? What is his PIN code? What is his, I mean, bureau level data? There are so many other parameters which we are not covering today, but only specific to the credit bureau, we can look into this. What number of overdue accounts? So we can define the characters of Money, which is a good customer. This is a high risk customer. Let's take another example. That customer, what are all the characters that belongs to him, right? So AI predicts that. I believe that you are able to see my screen, correct? So what is the characteristics of good customer and what is the characteristics of high risk customers? So based on that, the AI will give a signal, okay, whether to approve this guy or give a better pricing. It's a risk-based pricing. That is an interesting concept. If the customer is good, why don't you give a better interest rate for that particular customer, right? Those things we can analyze it. And also for the high-risk customer. So based on the pattern, based on your historic data, the AI will give you a signal that you have to take a call based on the customer behavior, right? So now I want you to do a homework, okay? So please go and talk to your credit manager, okay? And then ask this question to him, okay? Let's take an example. You take whatever example that you want, but take any parameter for that matter. For this example, let's take credit score. So for every lender, there is a underwriting policy. In that underwriting policy, credit score is one of the important parameters. Let's take 700 is your underwriting policy parameter. Okay, credit score. So ask this question as a homework. Please do ask this question to our credit manager today. If you change the credit policy to 680, what's going to impact in your system, right? So if you ask this question, they'll say that no, we will get a lot of risky customers. No, we don't know what will happen. No, 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 our NPA will shoot up. They will say based on their experience, but what actually works is completely different. This is what the next slide is. Right? So now you can see the score is 700. This is the current policy what you have, right? So the moment when you change it to 680, what are the things that's going to happen? What is the impact for that, right? So you can see there are so many borrowers getting increased. At the same time, how many risky customer is also getting uh, introduced into the system. The system will say that basically the AI will say that this is the simulated number. Your policy is 700, and the moment when you change it to 680, um, how many good customer is getting impacted, and how many good customers will get introduced in the system, and then how many risky customers are also there, which in turn tells you an important parameter like the growth. So the moment when you change this policy, then obviously the risk adjusted principal is going to be the huge. So this is the one of the use case which will helps the lending ecosystem. It will suggest the policy. Now, another interesting story that I want to tell you is, have you heard about this AI inside what people usually say about Walmart? So the interesting insight what I see from Walmart story, it's a very common story. You can search it in internet. Um, on Friday evening, an unusual behavior has happened, which is uh, every man, I mean most men will buy beers in the evening. At the same time, they also buy diapers. Okay, it's a strange analogy, right? Why would a person who buys diapers and beers together at the Friday night, right? But this is the while analyzing the transaction behavior, they have identified that these two products are tightly coupled. And the reason when they did the survey with a lot of men, what they find out is they came from the office and then they want to chill out on the weekend, so they buy beers. And then since they're coming from the office to the home, they are buying diapers because the wives are asking that, right? So it's like that. It's a very simple story. But the point is, the Walmart has identified that these two products can be combined together. Now, why I'm saying this analogy is this particular one single parameter, if I adjusted this policy, um, if one parameter is we are adjusting this policy, what is going to impact? What if there will be a multi variable? So this is what I want to tell you is, say for example, if credit score is this and enquiries is this, and then so you can see multiple variables here. And then in that case, how many good will be get introduced and what are the risky customers and what will be the approval rate, right? So what it is saying, right? If you are having only 10 variables, you can do it in an Excel sheet, period. It's very straightforward. But if we are going to have 1,000 variables, how will you basically identify which variables get along with each other, right? So that particular relationship, that hidden relationship, you can easily identify through the system. And it will also say that um, what is the best combination that it will works out very really well, right? And one more thing, you can also ask this, right? Um, what parameter is impacting the decision, where definitely the credit managers may not be aware of it. Say you have 20 parameters and you can there will be some usual parameter that has been in the underwriting policy and nobody knows whether this policy even impacting the decision or not. Nobody knows it. So it will also give the weightage for each parameter, whether this is really impacting the decision or not. You will be able to identify it. Yeah, I think with this, I just switch over to Hari. Um, so now I want to tell you the basics which have been covered. Now the another interesting part that's going to happen, which is what are the hidden parameters. Um, I think I'll switch over to Hari. Maybe Hari is sitting along with me now. Guys, can you see us both? 1 second. Yeah, yeah, Hari. Just yeah, I'm sharing my screen, right? Yes. Okay, we are moving on. Okay, before I move on to Hari, this is what the probability of default, right? Till now, we have been doing the post-mortem analysis, and now we want to predict the future, whether this customer will repay the loan or not. So we call this as a probability of default. The name, it's a straightforward thing, right? Probability of default. So the system analyze the list of variables and then it predicts, and this is the score that will come. This is the PD score. And what the PD score means is the lower is the better. And then so basically less than 5% usually automatic STP approval will be required, is automatically will go through. And if it is I mean, less than 20%, it will be like a needs review, and if it is go more than that, it's a straight reject. And so basically, PD is not a verdict. It's not a 100% confirm, right? It's a probability. It is not. It doesn't say that the customer uh, will default or will not default. It is a guess, and the guess is based on not based on the experience. It's based on the data what we have, so which is more meaningful, right? Yeah, I think, yeah, Hari, you will take her from there.
Yes. Okay, so just to give an idea, like I mentioned that you are going into a star hotel and then you eat curd rice. So these are the other items which are available. A few items are listed here. Obviously, there are thousands of parameters and predictors which are available. We may not be able to show the entire thing. So let's go one by one. I will just give a small, a brief thing about what these mean. So first one is called as a credit hunger index. So this basically shows how many lender's door is a borrower knocking before he gets a loan, right? Uh, Say for example, I can go, let's say I'm a good customer who has got a good intention to repay, right? So I know for sure that I would get my eligible loan amount. I would go and apply for probably one or max to max two lenders before I get a loan approval, right? So there would be people who would go and apply multiple times with multiple lenders, let's say 5 or 6 lenders at the same time. Of course, some people call it as window shopping just to know their eligibility, but there is also a different metric to it. It means that he has an urgent requirement for fund. So that is the reason why he goes shopping to lenders. At least let someone give me a loan, right? So this is one of the parameters where we look at. Here you are able to see that there is a guy who has made 13 enquiries in the last 90 days. Out of 13, he has got only about 2 loans which has got approved. So the score is about, let's say 13 by 2, which is about 6.5. So this is given in a very basic way so that we will be able to understand. Obviously, the scores would be different when it comes to the backend engine that we run. The risk scores, when it goes higher, let's say I make about 50 enquiries, but then I get only one, let's say I get about 10 loans. There the dependence and the financial stress is very high. So this is one of the parameter which I would say that we can look at. And then the next one is called as a loan stacking, right? Where let's say a guy picks up loan from multiple lenders. So this is probably a subset of whatever we saw earlier, right? One guy goes and applies multiple lenders at the same time, same day, for example. And in the same day, there would be cases where multiple lender also fund. Say, for example, in this particular file, on April 15th, the guy has taken 3 loans, which is about 1,85,000. So let's say lender A, who has given the loan on that day, would have seen the information which is prior to that. Lender B also prior to that, lender C also prior to that. So all of them would have given him a loan on the assumption that he has only X as his obligation. But on the same day, he has picked up close to about 1,85,000, which is about 3 loans. And in the last 90 days, he has picked up about 8. So in the last 90 days, twice he has done this scenario where he has availed multiple loans on the same day. So which means that this is a customer who goes knocking on everybody's door and then he accumulates the debt without probably having the consequence of it. So where the EMI burden of it increases, and there is also a very high probability because he is basically running on loans, right? So this is a very strong negative indicator that I would probably say. Yeah,
one more point that I want to add here, guys. I think these are all the data that is there in your credit bureau report. Okay. Say for example, when I see this report, I was actually got stunned because this guy is their obligation is very less, but this guy is able to take a loan on one single day. I mean 1,85,000. I'm sure that he is trying to make fraud, right? So you will be able to identify from the bureau report and then understand whether this guy has done loan stacking or not. So it is already there in your report. We are missing to see these data. That is what Hari is trying to say here. Yeah, go ahead, Hari.
Okay. So the next one, what we can say is called as a non-starter flag. So basically he takes a loan and then he doesn't pay the first EMI itself, right? So we have many people call it in different terms. Some people say quick mortality. Someone say this is non-starter. So here you can see. So this is, by the way, whatever information that we are giving, this is from past information of a credit bureau report, right? So here he has taken the loan on, let's say, 1st of January 2026. 31st is supposed to be his EMI repayment day, but then he has not paid his EMI on the first EMI itself. And the second EMI also starts to follow as a default. So this is a very strong indicator which we'll look at, because it shows his unwillingness or incapacity for him to repay back. And you have a very high probability for this particular file to go into a write-off or even what do I say, a bigger delinquent customer. So he might have closed this loan later. We were able to see that he has closed this loan later, but that closing this loan was by availing another loan, right? Which is a little bigger when compared to this. So this guy has availed close to about two loans of about 75 each, and then he has closed his loan of 50,000. So, but whether you should be funding this customer who has not paid his first EMI in the other one. Let's say if you have a rule engine which says that maximum of, let's say, 5 DPDs in the last 1 year, I'm sure this guy would have passed. But then all these flags is something that would arrive at an overall PD score.
Yeah, I think are we going fast? Are the first 3 points, the credit hunger index, loan stacking, non-starter flag? Do you guys have any queries on this? I mean, you can press, you can tell that you are able to understand. You can just okay, fine. You have any queries on these first three parameters? Chat option. So I mean, by the way, you don't need to wait till the end of the session to clear all your doubts. Whatever doubts that you have, please post it in the chat option. We'll try to answer it as and when that is we have time. Okay. Okay, we'll move on.
So moving on to the next one. So this is something called as a score trajectory, right? So one of the vendors, bureau vendors are giving this information to us, right? So we are able to see there is going to be a dip in his score over a period of time. In Jan 2025, his score is dipped to 538, right? So anybody who has probably caught hold of this customer over here, his score would have been about 720, here it's about 700. So we would have seen that his score is 700 plus. So probably he's a good customer. So why don't we go ahead and give him a loan? But as you can see, his score is already on a declining trend, right? So these are all places where you see early risk when it comes to a customer's scoring. Here you will be able to see something which is hidden, right? So we can't just go by only with the score. We will have to see how the score has behaved over a period of time. So this is a key factor when it comes to risk assessment as well as for limit management. So we can saying that, okay, fine. So I will not be lending this customer 50,000. I would be lending him probably about 25,000 just to try to keep my risk at the lowest. So these are all indicators which would give you some kind of analysis and some kind of bucketing of customers are concerned, right? So the next one is called as a delinquency severity score. Here you can see there is a lot of information which is available in the sheet, but let me give this to you in a very brief, right? So let's say someone writes an examination, somebody who scored 40 out of 100 versus somebody who scored 80 out of 100 would be different. Same way, we give different weightage to the DPD which is there. Somebody who has at a 30 DPD is different from somebody who's at a 90 DPD, or one particular loan. Let's say we have seen customers who have, let's say he would have missed one or two installments, then he would have paid back. But if you look at his CIBIL score, every CIBIL string, every month he would be at a 30 DPD for over a period of time. There would be other loans where, let's say, another client would have increased from, let's say, 30 to 60 to 90 over a period of time immediately. So all these are something which would indicate that a customer is a kind of, he's skipping his payments on a month basis. He doesn't have an intention to repay at all. And also there is a weightage which is given for the time period. Somebody who has made a DPD, let's say 60 DPD this year, would have a different weightage when compared to a 60 DPD which is made last year. So combination of time as well as the DPD weightage put together gives you a risk score as far as the delinquency severity is concerned. So this is also one of the parameter what is taken into account while arriving at a probability of default, right? So anyone has any questions in this delinquency severity score? Right. So let's move on. The other one is, this is probably I can say a positive indicator. This is a recovery after DPD. So there may not be a lot of scenarios where client goes through some kind of a phase during which he may not be able to make a repayment, right? So that could be a bad phase, but whether he has recovered from that and then started making his repayment, right? So this is a recovery after DPD. Here you can see month 1, 2, 3, 4, he was able to make payments on time, post which there was a period in which he was not able to pay, and then later he has regularized his EMI and then he started paying back. So this shows a little bit of intent from the customer's end, where he has an intent to repay his loan, and then whatever issue that he had was temporary in nature, right? So these are all the few things which are information which is already available in the bureau, right? But it's not something that you will be able to see in a human eye. So we will be having a poll on this. I request everyone to again please participate on how much of these signals or how many of these parameters do you use in your credit decisioning. Have you used any of these parameters in your credit decisioning is something that we would like you to answer. The poll is coming up. Please see the chat section.
Guys, like I said before, we are going to announce two surprises at the end of the session. So I request you all to stay tuned till the end of the session.
Wow, I'm able to see a lot of people voting for yes. I mean, this is really great if you're using parameters like this to analyze your day-to-day files.
But it's a question of how all six, or it's going to be any one of this, right? So we'll have to check that. Maybe we can have a separate discussion on that for the people who have voted it. Okay, fine.
Okay, we'll wait for another 10 more seconds. We've got about 20 responses. I request that at least we reach about 25 to 30.
People who are not able to take voting, please enter the chat option about your data.
Okay, let's move on. Okay, so let's look at this. So this is a basic information which is available in a bureau report, right? So this is again another poll which is coming up. Will you approve this case or not?
You can enter your option in the chat.
You can enter your option in the chat, or there is a poll, you can reply in that as well. Would you approve this case, yes or no? Okay, so we've got about 5 responses, 5, 6.
Somebody is raising the hands. Maybe you can if you want to say something, please put your options in the chat option. Yeah, you can carry on.
Okay, so we can see majority has moved on to the yes option. Obviously, there is a lot of uh, caveats behind this. So uh, we look at this civil data. This is what a regular business rule engine will say. So we look at the overall data and then we say saying pass yes or no, right? But then we will have to look at the in-depth data in this. So this is again a file which is from a live scenario, I could probably say, right? So this is where we had a non-starter flag. This is a place where we had about score trajectory as well. From 815 has come down to 720, right? So this is also a credit hunger index where in the last 90 days he had about 22 inquiries and only 6 had been availed. We also have a loan stacking information which is available for this particular file. So as we said, when we are able to look at entire data put together, even with a 720 score, we are able to see that this particular person, the AI has rejected saying, please don't go ahead because the probability of default of this particular customer is pretty high, right? So this is something that we don't get when we go with a regular kind of a decisioning. Right?
Yeah, fine. Yeah, I think see the important point here is you may have a fixed set of rules, right? And then we'll have to wait for a decision whether this is an yes or no. But there are a lot of other signals that you'll be able to see post the decision has been, I mean, pre the decision has been taken, right? So it will, I mean, the moral of the story here is it will gives you signals. Okay, these are all signals you need to check. And you can configure the same in your rule engine saying that, okay, if this signals is being coming, why don't you make it as an under review? Or you can make it as an STP or non-STP process that you can do it in the later stage. So the point is we want you to see all these signals before you even to take a decision. Yeah.
Okay, so let's move on. Uh, just we say earlier, business rule engine, BRE means business rule engine, but then there is also a behavior reconstruction engine. So something that we have been talking about for overall last close to about 45-50 minutes, right? So first, the same data what you get, right? So a credit manager looks at a CIBIL report from a PDF format. He looks at it from a printed format, which is attached to a file. If you're looking at probably secured lending per se, but then how technology receives the information is through a JSON or an XML where entire information comes in a structured format that is being injected into the engine, which creates thousands of variables, right? And from there, it creates a behavior and then risk signals, and then we give you the decision. All this happens in a matter of seconds, right? So which would otherwise take probably a credit manager. So let's say if I have to ask a credit manager to arrive at a I would say delinquency severity score for a customer, right? So he will have to go through every single DPD what he has made. He will have to calculate and then he will have to give a score saying what exactly has happened with this file. But then you get it in a matter of a few seconds. So this is the advantage what we have when it comes to AI in the bureau analysis engine, right? So today's bureau, what we have is the same input is the same, which is a raw bureau data. They process which checking the CIBIL score, active DPD, inquiry information, and all the other obligations and other stuff. And then they make a decision whether they have to approve this file or recommend to a senior or reject based on whatever it is. Limitations is that there is a possibility of high false positives as well as high false negatives, right? So I could have given, so this is a point that I would probably take over. I mean, would take it from what Mani had explained earlier, where if you change this parameter, what is the business impact? How much good business would you get and how much bad customers would you get? And overall, what would be the impact, right? So this is something that we will not be able to get in today's scenario. Versus if I have to say AI driven behavior engine, the input is the same. It's the same raw bureau data. The process it runs thousands of parameters in a matter of time, gives us the predictors and the value. And then decision, you can have a custom decision, whether you can say saying, okay, fine, this is a medium risk customer who for whom I would like to have a different loan amount limit, for whom I would like to have a different pricing, right? So that can be done. And the advantage is that it's not something that is static, it is dynamic, right? Over a period of time, you can make changes. Let's say I run a model for about 3 months and I'm able to get a certain uh, behavior from it. I want to make few more changes so that whatever mistakes I have done in the last 3 months, I don't repeat it here. So an example, what me and Mani, when we were discussing what he had given is, right now what we say is, uh, let's say we are receiving from a certain pin code, right? I'm receiving four more files from a pin code where the delinquency is high. So what we do is we mark that pin code as a negative pin code, but then we don't do an overall impact on how much files have come in and how much is going to be the business loss that needs to come from here. Whereas here, it tries to understand what is the change between the behavior within the pin code of which we have received the files also. So the changes are done automatically, periodically, so that you will have a better impact on your business, right? The next one is we spoke to a few credit professionals in the industry. What are the challenges that you face today? And what credit managers usually tell us is, first thing that they mention is, even with the available credit bureau, is they don't see the customer's true obligations. They are not able to find the EMI amount because majority of the files, there is no EMI which is mentioned. They are not able to predict the future behavior. They're able to see the past, but we know that while giving the loan, this was a good customer, but then he became bad. And then they say that we spend about, let's say, anywhere in the range of 15 minutes till about 40 minutes. So I've picked up 30 to 40 minutes per file in order to analyze the bureau for us to move forward. So this is time consuming. They're not able to focus on more files, unable to personalize lending decisions, right? Unable to distinguish borrowers with identical scores. Mani had mentioned in the beginning saying that somebody has scored 90 and somebody has scored 70. So whom would you rate better? So here we're able to see two guys who have scored 70 marks. One guy has moved from 90 to 70. The other guy has moved from 35 to 70. But then we are giving them the same weightage and unable to use bureau as an early warning engine. So what do you guys think? What do you think? I mean, do you think that you're facing these issues today? I just want an honest answer from everyone. If you can probably participate in the chat section, it would really be great. Do you face these issues or do you face these challenges on a day-to-day basis? Thank you. Thank you, Arunji.
Mm.
Thank you. Thank you, everyone. Thank you for your uh, participation. Okay, so I'm able to see that yes, people have given yes, and people have given few of the challenges. So one thing what we have is that reconstructing a true repayment obligation, right? So here we're able to see from the bureau report, you're able to see the let's say outstanding balance. Of course, obviously this has gone up and down. It's supposed to be high credit is 245 and outstanding balance is 1 lakh. tenure is 36 months, but then the EMI is missing, right? So we are not able to figure out what is the obligation from this. So generally what we do is we check the bank statement whether the EMI is debited from the bank account. If it is not debited, then we ask for repayment schedule or SOA, and then everything is a manual process. And credit decision, what you'll have to do is relying on the incomplete information. Unless and until the customer gives you the SOA or repayment track record, the file is on hold, right? So for that, what we have right now is something called as an EMI approximation, right? So this is an engine which is designed taking into account lakhs and lakhs of loans and parameters, where we're able to arrive at an approximate EMI depending on the type of product. Let's say a consumer loan of 50,000 rupees would have a different EMI when compared to a personal loan of 50,000, a two-wheeler loan of 50,000, right? A LAP loan of 10 lakhs would have a different EMI when compared to a housing loan of 10 lakhs. So the EMI, what the EMI approximation engine arrives at is almost 90%, more than 90% near actual in 90% of the cases. So this is the first step, what the AI does. Second one is an EMI reconstruction engine where anybody who uses a bank account aggregator or bank statement analyzer, we would have a certain set of information which would come in from the bank account details as well. Let's say bureau has an information where for home loan 12,500, for personal loan, credit card and consumer it doesn't have. Whereas a bank statement contains the information of it has this debit, it has a personal loan debit, and obviously it has a card payment also. But for consumer loan, it is not there. So for consumer loan, the EMI is reconstructed and we are able to figure out the exact EMI obligation. Here you can see credit bureau gives us 12,500. Bank statement and bureau put together gives us 19,600. But whereas the actual EMI which is being paid by the customer is 22,800. So this helps us in arriving at a more or less faster decisioning so that you don't have to wait for the customer to give you all the documents, right? So this is where it is, and the outcome obviously is a missing EMI should not become a missing underwriting decision. We should be able to make sure that we are giving the decision at the earliest with the available information with us, right? So this is one what we can say is a solution to the problem what they face. There is one more problem what they face is that in a lot of files, enquiry information is not complete. I'm able to see a loan reflecting, but then I don't see an enquiry available. There are some older loans which are not available in the bureau report. So there are certain bureaus which are newer in nature, which wouldn't have all the past or older informations available. And in new to credit and edge cases, I'm able to see saying that, you know what, how I'm not able to take a decision with the information that is available on one bureau, right? So reporting to all bureaus was not mandatory up to a while back. So not all loans would be reflecting in every single bureau. From now on, maybe they've made it mandatory so you can see. And then the data formats and frequencies, they kind of differ from bureau to bureau. So how we would be able to overcome these challenges is where we can have a multi-bureau check. So it is something where you can have a combination of, let's say, CIBIL plus Experian or Experian plus Equifax, or a combination of all four put together also, right? And when I say this, going through one bureau report takes about 25 to 30 minutes for a credit manager. But if he has to go through four reports, for him also it is time consuming, right? So whereas AI does all these comparisons and decisioning within a matter of few seconds so that you don't miss out on NTC or edge cases. You don't miss out on the loans or the obligations which a customer has, right? So where you have the entire visibility as far as the inquiry details, as far as the loans which is taken, you can make a better decisioning, right? So this is something that I thought probably would uh, be a supporting thing to the challenges what is being faced, right? So Mani, would you like to probably pitch in?
Yeah, here, see, this multi-bureau check, I understand from the commercial standpoint, it impacts a lot for an lender. But at the same time, as Hari suggested, this is only for the edge cases or the cases uh, which are in a dilemma state whether we need to approve it or not, these guys, right? So for a safer condition, whenever there is I mean there is an option in A where you have a fallback option. So only if this condition is not satisfied, then you call the another bureau, right? We can configure such a way that the cost will be optimized, right? Yeah, that is I wanted to highlight here. Yes.
Right. So overall, what we will have to, the people who have used AI and based on the, what do I say, industry surveys which is done, we are able to see that the approvals have increased about 20-25%. Delinquencies have reduced in the range of 20 to 40%. Turnaround time is reduced almost about 50%. And then we are able to give a proper pricing to a proper customer, in which we are able to attract or retain good customers at a good rate. At the same time, we are able to price bad customers at a higher one, which increases or which impacts the profitability of the organization directly, right?
I think there are a few questions have come on to the chat option. See that help. I mean, does AI help reduce the NPS? Of course, yes. That is what you are seeing in the slide. It definitely lowers the delinquency, and you can see the industry reports 20 to 40%, and loan processing time, right? So one of the important question, yeah. So here, uh, if I mean the Hari's example, if you take. um if the obligation is not there, then the system will be able to identify what is the missed obligation by checking with the bank statement data or comparing with the basic whether how which loan product that is and what is the EMI, and then finally the system will be able to arrive the obligation, and then we'll be able to take a decision instantly. So definitely it will improves the timing. And which LLM are you using? I think this is the tech question, Sarthak. I'll come to that in the last part. Maybe I'll have a respective person to discuss this. One second, give me some time. We'll move on to the next part. So we'll take another 5-10 minutes, and then we'll be able to wrap it up the session because it's time. I will just quickly check my time.
Yes.
It's 5:10. Okay.
So these are all the sources which are available from Upstart, Just AI, McKinsey, FinReg Lab, and other alternate data. So which can back the evidence saying that AI has definitely helped improve. So just a few more things that I would rather probably put up. We can just have a quick glance in terms of what are the parameters that are there, right? So this is out of 1,000, we have probably cherry picked about 20-25 odd. So just to give an explanation, we have something called as an identity stability score, right? So how many name variations are there? How much email ID variation is there? How much of PAN variation is there? How many addresses is changed? And in the last 6 months, how many changes are there? So is this guy somebody who's got a stable identity or not? Of course, credit hunger index, we've seen enquiry velocity is where over a period of time, let's say suddenly if you are able to see that he's starting to have more inquiries after a long period of time, we can say loan opening velocity, how many loans he has been availing. So this is average gap index, is the gap between availing two loans. Has it increased or has it reduced? Rapid refollow flag, enquiry burst, score trajectory we've already seen. Uh, we have something called as round tripping, where let's say one loan is closed on, let's say 10th of April. There is another loan which is opened on 10th of April. We can see that he has availed one more loan for him to close this active loan ratio, um, outstanding per loan, current balance ratio, highest delinquency period. So we also look at which particular period was the client highest delinquency in, and this will also come along with recovery from a DPD. We will compare these two and then arrive. And then there is also a payment clean ratio where we also compare on which period was the client on a regular repayment. There is a non-stock starter flag. So these are all basic ones which are easily understandable. So that is the reason why we have put it here, just to showcase a few parameters which are available, right? And of course, this is where I take off. So bureau is pulled, BRE scores it. We route it as a decision. officer reviews it, and then we will be able to approve. I mean, only the edge cases are referred to the officer, and obviously it is a learning model where out of all the information which is gathered so far on an everyday basis, uh, the the engine keeps changing itself for the betterment in order to how do I avoid these customers. Let's say I funded about 1,000 loans and I'm able to see that 10 or 15 have gone bad. How do I make sure that I don't get this 10 or 15? How do I not repeat this 10, 15 loans in the next phase? So that is how the machine keeps changing itself. It keeps learning automatically, and that's how we control our judgment, right? Over to you, Mani.
Yeah. I mean, thank you all. We'll take a few questions. So one question, I think, Sarthak, which LLM are we using? So first, on for the decision making probability of default, we are using algorithms like logistic regression models, and then multiple machine learning models to stick on that logistic regression and XGBoost that we are using it. With respect to LLM, to summarize that data, we are using LLMs like OpenAI and Gemini for that matter, right? We can have an in-person discussion with Satak, and how can we'll move on to the next question.
How can AI improve portfolio quality?
You want to answer?
Yeah. So, like we mentioned, portfolio building, this is a learning which happens on a continuous basis, right? So once we have a study in terms of what has gone wrong in the portfolio, if we make sure that we don't have the new loans which are coming in, we don't make that mistake, obviously you will have a better portfolio coming down the line, right? While checking multi-bureau, will it put multiple enquiries in the bureau? It depends whether it is a soft pull or hard pull. It depends on which kind of cases would you like to take the Mani had already mentioned, saying that for edge cases or a condition saying that this is how I would want, this is when I would want a multi-bureau. I would want to pull 2 bureaus or 3 bureaus. So you can make the condition. It doesn't happen for every file. It happens only when you're having an impasse while making a decision.
I think another interesting question what we've got is handle document verification and policy screening. See, actually, one of the use case that we've got is in the left-hand side, RBI recommends a loan agreement has to have these components, right? Let's take an example. So it has to have a KFS, it has to have a multi-language. So there are list of components should be there. Inside KFS, they have to have the APR. So there are a lot of things that they keep changing. The RBI will keep changing the policies, then the document should adhere those policies, right? So for which I think AI can definitely help you on that. And of course, for the loan against property, there are so many use cases to try to take the lot of data from the encumbrance certificates, a lot of other documents. Definitely that will help. Earlier, it was very difficult because they were using a technology, OCR technology. Now the entire technology has been changed because of the AI. We can able to read a lot of good things. Now you can read it very easily through the latest technologies. Yes. No, I think recently, maybe I can just put it down here. So it has to be a white box. So even whatever LLM that you're using for credit decisioning, you have to be, I mean, last week there is a policy given by RBI which says that you can use any model, but the model should be transparent enough to tell the customer that these are the reasons that you need to tell why you have rejected that particular customer. Whenever there is an audit comes, you should be able to question to explain, okay, for these reasons that you have rejected this borrower, right? There should not be so. So there is in a AI world, there is a term called ethical hacking. So there will be certain bias towards that should not happen while building a model. We have to be very careful on that. Okay, so we are currently using a ML model to predict PD, and we have a creditable decisioning score. So it is a what you want to answer it, Alex? Yeah, fine. Model predominantly depends upon credit bureau data. What that? Yeah, I think to build a model, right? Like I said before, see, so we have to this answer takes some more time, but we can connect it personally. So one is on the bureau data. What are the data that you can take? It is a device intelligence data that recently popping out really well. And bank statement data, obviously. So then next is would be the social profiling and all. See that recently I came to know that with the help of the mail ID, you'll be able to take a lot of data. So in the mail, in the Gmail, you will have a lot of current bill that you are paying it out. It's paying on time, right? And in the mail, you will get so many information. So with these data, you'll be able to arrive the model in a better way. Maybe we'll take this question offline, Vignesh. So in the interest of time, we like to introduce those two surprises. Okay. So one surprise is first is we are going to conduct this AI series. The next meeting is going to be the AI meets bank statement analysis. So next month we are going to conduct that session. But next month also you're going to see the same face. Sorry guys. So that is the surprise number one. The surprise two is we want to prove whatever we said, right? So give us the files. We are ready to do a free POC. So we will. Whoever has shown interest, you just ping us. You can just send out an email to money@cloudbanking.com. So there is a chat option. Would you be interested in a POC or not? It's a free POC. You don't need to pay anything. So we will tell you how many are actually good and how many approvals were actually risky, right? So we will classify your data into who are all good customers versus high risky borrowers. We'll be able to identify that. So feel free to share the data. I think we'll be able to give your responses. Yeah. So we'll wait for 5 more seconds. So happy to have a conversation with you. So next session is going to be bank statement data. What are all the insights that you'll be able to take the bank statement data? There's so many insights that you are able to getting it, but what else, which is more important, that it impacts the decision, that those are the data that we want to showcase you guys. Okay. All right then. No.
What are two surprises? Internet got disconnected, so you can probably mention again, Mani.
So the surprise number one is Arun. We are going to conduct this AI series in the month on month. The next session is going to be on AI meets bank statement data. Okay. The surprise number two is we are going to do a free POC with whatever data that we have. Whatever we said in the meeting, we are wanted to prove that. So give us the files that in the decisions that last quarter. Ignore the important information, confidential information like proof of identity and proof of address. You can just remove that and just send me only the loan information and bureau information. We'll be able to sort it out. Okay. Thanks, guys. Thank you so much. Thanks a lot for your time. Let's stay tuned for the next session. Thank you so much.